What is going on, guys, and welcome back to another very exciting video. In this video, we are going to be taking a look at Alibaba, and Alibaba is one of the most interesting stocks in the stock market right now, just because of how investors are interpreting the valuation of the company. And what I want to do in this video is I want to break down what's going on with Alibaba. They announced that they're splitting the business into 6 different units. So we're going to go over some of that, how that could help with valuations. Then we're going to take a look at their earnings and where their earnings are headed. And then finally, we're going to give my opinion on valuation, where Alibaba is trading right now and where I think it should be trading in the future. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Before we get into all of that, let's go ahead and take a look at their chart. So they were down almost 2% here today. Over the last 5 days, we can see that the stock is down almost 8%. Over the last month, up a little over 6.5%. Over the last 6 months, up 41%. And over the last year, we can see that they have basically traded sideways and are up a little over 3%. Things get really scary when you look at the last 5 years. The stock overall is down almost 50% in the 5-year span. If we look from all-time highs, however, we can see that the stock once traded over $300 and since then has fallen over 70% to where it is trading at now, just under $90. And this decline of 70% of the stock value has really occurred due to a number of factors. The first being the potential delisting of Alibaba from the New York Stock Exchange. And this really occurred due to China blocking US auditors from coming into the country and looking at Chinese companies' books. However, last fall, the Chinese government and the US government came to a deal that allowed auditors to go in and look at these companies' books, and overall things went well and they have been given the green light to stay listed on the New York Stock Exchange. Another factor that has contributed to this decline is the zero pandemic policy that China has had in place over the last couple of years. Basically, what this has done is closed sections of the country when the pandemic cases have started to spike in that area, and that has really disrupted a lot of the economic growth throughout China. However, over the first 3 months of the year, we have seen China get back to growth as they have experienced 4.5% growth over this period. And the final factor that has had a big effect on the stock price for Alibaba is really the general economic conditions we have seen over the last year. We know that interest rates have increased in a massive way in a very short period of time, and oftentimes what that does for investors is it allows them to look at businesses and their valuations in a different manner. Oftentimes, investors will take a less risk-on approach because they can achieve higher risk-free returns from high-yield savings accounts. So 2 of those 3 factors have really started to get mitigated. The first being the delisting concern. We have seen those audits go through and basically the FCC say that Alibaba can stay listed on the New York Stock Exchange. The second being the zero pandemic policy. We've seen China start to drift away from this policy as there have been riots and things throughout China, and they have talked about reopening the economy fully and really started to implement that over the last few months. So the final concern that is really weighing on investors is the overall economic concern. Right now, obviously, investors are looking at businesses and looking at the safe rate of return that they can get from savings accounts, and it is a little bit more difficult to invest in something that is seen as a risk-on asset like Alibaba. So what Alibaba has thus done is they have looked to break up their business into 6 different businesses to really allow investors to invest in what type of business they want to, whether it's a value type of business like Alibaba's e-commerce business or a more high growth type of business like their logistics or their food delivery services. Some of these businesses will have very high growth rates that we've seen from Alibaba in the past. We have seen over some of their years where they have been able to grow 30 to 50%. But more recently, we've seen that number drop down to 19%. And in the first couple months of 23, we saw them just grow by 2%. So there's been a lot of differences in growth rates that we have seen that have really restricted some of the valuations that investors have been able to put on a business like Alibaba. It can also be difficult for value investors to really value Alibaba due to the fact that their other segments are currently unprofitable. Their e-commerce segment is their only profitable segment, and with these other 5 businesses dragging down EPS, it can be difficult for a value investor to look at Alibaba favorably. Also, with the success that Alibaba has had over the last 10 years, it has been difficult for management to keep up with this growth. When you think about a business and how it grows over time into multiple different sectors, it can be difficult for that management team to still manage all of those businesses effectively and make decisions in a quick enough time period for them to stay competitive. And with all of those factors, it can be difficult for investors to accurately determine the valuation of a company like Alibaba, and that shows through their forward PE ratio. We can see that currently they're trading under an 11 forward PE, and then a few months ago they were actually trading all the way down below a 10 forward forward P ratio. One thing that will help investors accurately value Alibaba as a business is their earnings announcements and how those are trending over the next couple of quarters. We can see that they are projecting right now that Alibaba will announce their Q1 earnings on May 25th of 2023. And for this quarter, analysts are expecting $1.37 in EPS. And for the year of 2023, we have an average estimate of $7.78, a low estimate of $7.38, and a high estimate of $8.13 of EPS. And based off those earnings estimates, we can come up with forward P ratios for the average, the low, and the high estimate. So for the average estimate of $7.75, we currently have a forward P ratio of 1150. For the low estimate of $7.38, we're currently sitting at a forward P ratio of 12.08. And for the high estimate of $8.13, we have a current forward P ratio of 10.96. On average, the market tends to trade between a 20 and 25 PE ratio. So we can use that to compare the current PE ratio for Alibaba based off these earning estimates and come up with a potential return for Alibaba. So right now, if the stock is trading at an 11.50 forward PE ratio, and if it were to trade up to a 20 to a 25 forward PE ratio, we would see the price trade to $155 to $193.75, which would be anywhere from a 74% return all the way up to 117% return. For the low earnings estimate, we have a current PE ratio of 12.08, and if it were to trade up to between a 20 to 25 PE ratio, we would actually see the stock trade to $147 to $184, which would be anywhere from a 65 to 107% return. And for the high EPS estimate, we can see that the current PE ratio is sitting at a 10.96, and if it were to trade between a 20 to a 25 PE ratio, we would see the stock trade anywhere from $162 to $203, which would be an 82 to 128% return. The reason I personally own Alibaba stock is because I don't think investors are accurately determining the value of Alibaba. I think that right now the stock is being undervalued because investors are looking at savings accounts where you can achieve 4 to 5% returns by simply sticking your money in a risk-free savings account, and they think that that is going to be a good return for now. But Alibaba, in my opinion, is trading at an incredibly low valuation, and I think in the next 3 to 5 years that valuation will change and investors will begin to start jumping into the stock and really pumping up that valuation back to what's more reasonable of around a 25 PE ratio. So again, that is all my opinion. Keep that in mind. Do not invest in a company just because some random guy on YouTube talked about it. Make sure you are doing your own research. Alibaba does have a lot more risk than US based companies because you never know what the Chinese government is going to do. So I personally have a lot of years ahead of me, so I can take on a little bit more of that risk and still be comfortable with it. But you being in a different situation may not be able to either take on or be comfortable with that risk. So keep that all in mind. And again, do not invest in a company just because some random guy on YouTube talked about it. So I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your day.